We see the book value is 5, scrap value is 0.5, replacement cost is 5.50. There are three different types of costs which are mentioned. After that, the special contract would require 10 kgs of material. So the decision is related to 10 kgs of material X. There are 250 kgs of this material in stock, which was purchased in error over 2 years ago. That is historical in nature. It has just to be noticed that if X is modified at a cost of 2 per kg, did we do a similar type of question? If it is modified at 2 per kg, then it could be used as a substitute for material Y, which is in regular use and currently costs 6 per kg. So the current market price of that is 6 per kg, but then modified cost is 2 per kg, which has to be deducted. The previous question is also on a similar note. Do you see that? Current market price is 6, but the modified cost will be 2 per kg. So that has to be reduced, and find out what is the cost per kg applicable for 10 kgs of material. The rest of them are all um, historical. Book value is historical in nature, and then scrap value if they sell it. But right now they would require 10 kgs of material. So what is it about that material which is already purchased and been in their in the books of accounts? So that is not relevant for the decision making. The present decision is they need to purchase this material of 10 kgs. So material requirement is for is 10 kgs. Current price of material. This is 4. Then modification costs are 2. I'm so sorry. This is 6. Okay. So the relevant cost is equal to 6 minus 2. Only 2 of you, for that matter, once in a while Meda comes. How are they following? Because only 2 of you are attending, or 3 of you, let's put it that way also. 3 of you are attending the classes. What are the others doing? No attendance, which is considered.
Ma'am, we don't know. I don't think the coordinators know that only 2 people usually come.
Okay. No, the other day something was there, and I have posted a message. I said, I'm on leave, I will not be able to take it. So initially both of you have said yes, ma'am. That makes sense. But then some of the students whom I don't even know have responded yes, ma'am. Okay. Let's take up the next one. A company has been asked to quote for a special contract. The following information is available on the labor required for the contract. The special contract would require 100 hours of labor. However, the laborers who are each paid $50 per hour are working at full cost. There is a shortage of labor in the market, and therefore the labor required to undertake this special contract would have to be taken from another contract Z, which currently utilizes 500 hours of labor and generates $5,000 worth of contribution. If the labor was taken from contract Z, then the whole contract Z would have to be delayed, and such delay would invoke a penalty of 1,000. What is the relevant cost of labor? Till now, the questions what we have looked into were about the one which is most relevant. Here, a decision about accepting a special contract, but they do not have resources. So the special contract would require 100 hours of labor. However, the laborers who are each paid $15 are working at full capacity. So they do not have the capacity to take up another order. So what are they considering? They're considering to take the hours from the there is another contract going on Z. It says that there's a shortage of labor in the market, and therefore the labor required to undertake the special contract would have to be taken from another contract Z. So what has to be the decision? The decision would be to delay. Here it is delay. Sometimes the situation could also be to stop that particular product. The production of that product also is temporarily withheld. Here it is delayed, withheld, stopped, whatever is that. So right now they see that the special order to make it possible, they even are considering making adjustment to the present situation. So they are going to take the number of hours from contract Z, which currently utilizes 500 hours, and a contribution of 5,000 worth is there. So that at present they have to forego. See, immediately if they continue with contract Z, they will earn this $5,000. Fine. That is now not going to be received by them. Plus, we also see that there is a penalty which is now this delay is attracting a penalty of $1,000. So this is what has to be looked into. If they completely divert it and not take up anything about producing or taking up this contract set, or if let's say if it is multiple products, one product is stopped, so the contribution will be foregone. So then that foregone contribution is an opportunity cost. So that foregone contribution also should be recovered from the special order. To accommodate this special order, they want to make so many changes. But here in this situation, it is not shutting down, it is not closing down, it is not completely diverting. The situation is only about delaying the project. So delaying the project will attract a penalty. That is what is mentioned. So there would be a penalty. They have to bear that. If they have to pay the penalty, it's an additional cost. So rather they collect it from the new the special contract. So the relevant cost here, the cost which should be charged for the special order, that is what is the relevant cost. How many hours do they require? The special contract would require 100 hours. The cost, because we are asked to find out about the cost of these 100 hours is $15 per hour. If one product is stopped or contract Z is closed, we should also consider 5,000, but that is not closed, it is only delayed. So if not this month, they will receive in the next month. So it is only a temporary adjustment. But as against this adjustment, now they have to pay 1,000 additional cost. Instead of they paying, they rather collect it from the special order. So right now the relevant cost would be for 100 hours, paying at the rate of $15 per hour, plus also a penalty of 1,000. Okay. So let's put this one, cost of labor.
One,
Yeah.
does this mean that the contribution that you will get from contract Z will temporarily become an opportunity cost?
If they stop it, then it becomes an opportunity cost. Because why should they forego just to accommodate special contract? Why should they forego? In situation if they completely close contract Z so that they can take up the special contract, this 5,000 also will be added to 2,500. But this situation is only delaying. So eventually they will receive, maybe not immediately. So it is not a opportunity cost. But let's say they close it, then that 5,000 will be added here, and the special order price will be 7,500.
Okay.
Yeah. 166. A company is preparing a quotation for a month consultancy project. Currently, the company employs a consultant on an annual salary of 36,000. This consultant is fully employed on current projects and if she were to be transferred to this new project, then an existing junior consultant would be used to cover her future work. The junior consultant would be paid a bonus of 5,000 for undertaking this additional responsibility. Alternatively, the company could hire an external consultant on a 1 month contract at a cost of 4,500. The relevant cost to be used in preparing the quotation is a consultant whose salary is the consultant is fully employed on current projects and she were to be transferred. So if it is 36,000 per month and would be paid a bonus of 5,000 for undertaking this additional responsibility. Alternatively, the company could hire an external consultant as a 1 month contract. Okay. The present annual salary is a fixed cost, which would not be changed. So this is irrelevant. The company is preparing a quotation for 1 month consultancy project. The company currently employs a consultant on this salary. So the consultant is already employed by the company. Now there is a new project. This consultant is fully employed in current project, and if she were to be transferred to this new project, if they are to be considering this new project, transferring this consultant to the new project will attract additional cost, and then an existing junior consultant would be used to cover her current work. The junior consultant would be paid a bonus of 4,000, would be paid a bonus of 5,000 for undertaking this additional responsibility. Alternative, there's another alternative which is provided. The company could hire an external consultant, and the external consultant will be paid a amount fee of 4,500. Now the choice is, this is irrelevant for decision making. This is already implied. The consultant moved to a new project and paid a bonus of 5,000 versus to take up the work of the new project, external consultant can be appointed and paid a amount of 4,500. Which one is better? Moving the present consultant or appointing external consultant? The decision would be whichever way they would be cost saving, that is the appropriate one. Where would they be saving the cost? They would be saving cost if they appoint external consultant, isn't it? So relevant cost will be 4,500. Bonus paid to junior consultant. Cost of hiring. Would you like to view the recordings? You want me to share the recordings?
Ma'am, from the Google Drive.
Every class gets recorded, so I have all the recordings with me. And that's a time taking process, so I was not sending that. Please put both your addresses in the chat box. So I'll copy that. I don't know whether immediately I can send, but coming week there are holidays. Maybe I will be able to find some time. I'll send all the recordings to you. You can share it with your classmates also. Um, Otherwise, I'll make a folder and put that in. There is a group, no? You put your mail ID, so I will share it with you. Relevant cost of 167. Jones Company is bidding for a contract which is due to be started within a few days. The contract will use up its stock of material XY, which will otherwise be held for 1 month. In 1 month's time, there is a probability of 0.6 that it will be used. If it is not used, then the material will be sold. Estimates are as follows: replacement cost of stock in 1 month's time, sale value in 1 month's time, stock holding cost for 1 month 900. The expected relevant cost of material XY for use when evaluating the viability of the contract is. Did we do expected value? I didn't teach you, no, expected value. Forecasting techniques, did I teach you expected value? We learned high-low method, we learned trend analysis, we learned regression analysis. Okay. We have not done expected value. I don't. I did. Okay. Yes.
We haven't done expected value.
I have not done. That's what I recollected. This is another technique of estimating that when probabilities are given. Here there is a probability of 0.6 which will be used. If not used, then the material will be sold. So there are decisions, there are alternatives which are available. The probabilities are also given. So there is this is also a forecasting technique that is about calculating the estimated value. Estimated value when multiple things are taken into consideration. That I will explain to you, and then let's take it up. That's what I was thinking. Should I take it up, or after I teach you that? But where will it come? I don't know. Let me teach that. Doesn't matter. We are asked to find out what is the expected relevant cost. The question talks about the contract will use up its stock of material XY, which will otherwise be held for 1 month. In 1 month's time, there is a probability of 0.6 that it will be used. So the chance of material to be used is 60%, 0.6 is 60%. Then what is the chance that it will not be used? The remaining part of it. If out of 100%, 60% is used, 40% it will not be used. So the sum total of all the alternatives should always be equal to 100% or 1. Let's say if a coin is tossed, the probability that it will be a head is 1 by 2. Out of two options, head and tail, one option we are looking at head. So 1 by 2. If a die is thrown, the chance that a number 2 appears is there is only one number 2. So 1 out of 6 alternatives. So 1 by 6. So when we add up all 6 times 1 by 6, then the sum total comes up to be as 1. So the sum total of the probability is always equal to 100% of 1. So if it is 0.6 here, the probability that it will be used if it is 0.6, it will not be used can be calculated as 0.4. So that's the first part what we have to look into. The chance that the material which was purchased a few days back, so the contract will use up its stock of material which otherwise will be held up for 1 month. So they already have that material with them in the stores. So for the new contract, there is a chance that they can use this material, and the probability that it will be used otherwise, generally, the probability that the material will be used is 60%, not used is 40%. Next, the replacement cost of stock in 1 month's time is 15,000. Sale value in 1 month's time is 12,000. Replacement is 15, sale value is 12. When would they replace that? The replacement situation arises when the stock which is there in the stores department is consumed, it is used. If it is used in that place, something else should be purchased and brought and replaced. Okay, that's the situation. So if they happen to replace it, the replacement cost of stock in 1 month's time is 15,000. Okay, next part. It says that sales value in 1 month's time. If it is not used, then the material will be sold. If it is not used, then it will be sold and the sale will generate a revenue or a cash flow of 12,000. Cost of holding the stock for 1 month is 900. Let's present this. The concept of weighted average, concept of expected value is an average value, which is the weighted average value. What is the formula of weighted average x bar w? You must have come across somewhere in statistics about the weighted average concept. The weighted average concept says that multiply the variable x with its respective weight, sigma wx divided by sigma w. So this is the concept of weighted average. So in fact, I think this would be covered under risk and uncertainty. We have a concept called as risk and uncertainty. There you would be learning expected value, because we would be learning about minimax, maximax, maximin, maximax, minimax, regret rule, and expected value. These are the four techniques which are used. So because you would be learning there, that is brought and mixed with this one. So I mean, anyway, we would be learning about expected value. So here, if they are considering alternatives, what does expected value go with? It says that instead of being biased towards one particular option, here the options are that it will be used or it will not be used. Why be biased towards anything? Consider both of them. That's the concept of expected value. So when there are multiple alternative options available, alternative options, take all the options. That is the concept of expected value. So on an average, what will be the value is what has to be calculated. So the variables here, what we are looking at is, see, if at all, if the material is going to be used, it will be replaced at a value of 15,000. If it is not used, it will be sold at a value of 12,000. So these are the two cash flows. So let's put this one. We have first, for individually, for each of these options, probabilities are given. So let's first mention the probabilities. So probability is, first one option it is 0.6, another option it is 0.4. Okay. Then we have to look at the cash flows. The cash flows are, one cash flow is 15,000, or the other cash flow is 12,000. So let's put this cash flows. This is only about the expected value of two different alternatives. But we are asked to find out about what is the expected. I'm erasing the formula. What is the expected relevant cost? It is just not the expected value. It is talking about what is the expected relevant cost of material XY for use when evaluating the viability of the contract. So there are two situations. Okay, two situations about the material being used and not being used. So the expected value is this much. One more thing is about the if the material is there in the stores department, there will be some storage costs. We call them as holding cost, stock holding cost. If they hold it in the stores for 1 month, they would also be incurring a cost of 900. So it is not only about this option, but as against that, the other alternative where the material is lying there in the uh, stores department, and they will have to be incurring this 900 cost. 900 cost, stock holding cost of 1 month is 900. We are looking at the probability of the material either being used by them. So it says that Jones Company is bidding for the contract which is due to be started within few days. Contract will use up its stock material. When they use it, then this is 15,000 what will be generated. The probability is 0.6. Not used will be sold. No matter what it is, it says that if not used, then material will be sold. But no matter what it is, it will be there in the stores department for few days. So for the next month, they have to incur the storage charges. That will be starting within few days. So until then, they have to keep this material. So they cannot just sell away right away. Right away, they cannot sell this material and then have a possibility of not incurring that cost. In any case, this cost of storing the material, holding the material, has to be incurred. The option, there are two different options where revenues can be generated, so the cash flows can be generated. So we have taken both of them into consideration. On an average, the expected value stands at 13,800. But what about the cost which is incurred? The cost which is incurred to keep this material for the coming few days. So the next month they have to pay the storage cost. That storage cost is 900. If that is deducted, then we see the expected relevant cost of material. The next one, question number 168. In order to utilize some spare capacity, XK Limited is preparing a quotation for a special order which requires 2000 kgs of material J. K Limited has 800 kgs of material J in stock. Original cost is 7 per kg. Material J is used in the company's main product L. Each unit of each unit of L uses 5 kgs of material J, and based on an input value of 7 per kg of J. Each unit of L yields a contribution of $10. The resale value of material J is 5.50 per kg. The present replacement price of material J is 8 per kg. Material J is readily available in the market. The relevant cost of 2000 kgs of material J to be included in the quotation. So there is spare capacity. So that's the concept here. If they are preparing a quotation for a special order which requires 2000 kgs of material. K Limited has 800 kgs of material J in stock. Stock already purchased and in stock. Uh, the original cost of it is 7 per kg. This is all historical in nature. They have already purchased that. Now there is nothing to be done. Material J is used in the company's main product L. Each unit of L uses 5 kgs of material J, and based on an input value of $7 per kg of J. Each unit of L yields a contribution of 10. The resale value of material J is 5.50 per kg. The present replacement price of material J is 8 per kg. Material J is readily available in the market. Just look into that and then see which one are relevant. So important point here, what is it? See, if they have already 800 kgs of material J in stock, original cost is 7. Material J is used in the main product L. L uses 5 kgs of material J based on an input value of $7 per kg of J. Then L is yielding a contribution of 10. Any part of this paragraph can be considered this as a relevant cost. That is what has to be looked into. Think about it. Then the last paragraph talks about the resale value of material J is 5.50 per kg. The present replacement price of material J is 8 per kg. Replacement is when the present stock is already used by L. In place of that, additional material purchased. So that is additional thing. The present stock is consumed by the production of L. So L will consume everything. The new set of material which will be required for this special order can be acquired at the present replacement price is at 8 per kg. So out of this given set of information, what would be the relevant cost? The relevant cost of 2000 kgs. So required material is 2000 kgs. Anything to do with the historical cost? Nothing to do with the historical cost, which is already purchased or available there in the stores. So this so the second paragraph about acquiring at 7 historical in nature is not relevant. They would not be stopping the production of L, delay anything, nothing will be taken up here. Why? The first line it says that they have spare capacity. So the work will go on as usual. No compromise on the production of L. L will continue to be manufactured the way it is being done now. The point is spare capacity. The previous question which we have considered about delay in the project was a situation where they are at present working at full capacity. Here they are already working at full capacity, so therefore they have considered delaying that contract Z. So there we have looked into that opportunity cost part of it. Opportunity cost doesn't arise in this situation because they have spare capacity. So the whole of the second paragraph is completely irrelevant for any decision. Okay, we would not be considering that now because they have spare capacity. This material will be consumed by for the production of L. The present material will have to be replaced by additional material. Additional 2000 kgs material has to be purchased to take up the special order. The current replacement price of material J is $8. So find out what's the cost. I hope it is clear.
Yes.
Then we have question number 170. Question number 170 says, a company is calculating the relevant cost of the material to be used on a particular contract. The contract requires 4,200 kgs of material H, and this can be bought for 6.30 per kg. The company bought 10,000 kgs of material H some time ago when it paid 4.50 per kg. Currently, 3,700 kgs of this remains in stock. The stock of material H could be sold for 3.20 per kg. The company has no other use for material H other than on this contract, but it could modify it at a cost of 3.70 per kg and use it as a substitute for material J. Material J is regularly used by the company and can be bought for 7.50 per kg. The relevant cost of material for the contract is. Modify it at 3.70 and then use it for material J. Material J is regularly used by the company and can be bought at 7.50. Modification cost is 3.7. What is the complete requirement of material? They require total requirement of the material is 4,200 kgs. Four thousand 200 kgs of material is what they require. Then when we look into that, the next paragraph, the company bought 10,000 kgs of material H some time ago when it paid 4.50. This is irrelevant. This is historical in nature. So when they have paid 4.50, it is not relevant for us at the moment for decision making. Currently, 3,700 kgs of material is there available in stock. The stock could be used for 3.20 per kg. The stock of material H could be sold. The stock of material H could be sold for 3.20 per kg. The company has no other use for material H other than on this contract, but it could modify it at a cost of 3.70 per kg and use it as a substitute for material J. Material J is regularly used by the company, and the company can be bought by the company and can be bought for 7.50 per kg. So there is one material J which is available. The cost of material J is 7.50. Done. So 7.50 is the cost of material. Modification costs are given as 3.70. 7.50 minus 3.70 modification cost will be the relevant cost. So let's present the relevant cost part of it. Cost of material J. They require completely 4,200 kgs of material. Relevant cost is 3.8. Okay. There are two different materials. Material H is available with them. Material J could be purchased. Material J can be modified, and the relevant cost of material J will be 3.80. but they already have one stock of material H, which could be bought at 6.30. That is an alternative which is available with them. So choice is between H and J. H and J.
Ma'am,
Uh-huh.
but they've given no information about the requirement of material J for this contract.
Um, what is? I didn't understand your point. We are
Ma'am,
only,
the
yeah.
question is what is the relevant cost of the material for the contract? And it just says that the contract needs material H. So why have
No,
they
it
given?
doesn't say. It doesn't say. So there are two options available as of now with them. One option is they have material H already available on hand, and another option is they can buy material J, and the relevant cost of material J is 3.8. Now, if material H has to be used, because already 3,700 kgs of material H is available, the alternative for H is there are two different alternatives. Either they use this material for this particular contract, or they use it or sell it. Sale value is much lesser. That is what we are looking at, 3.20. If material H is not used for the special contract, all what can be done is it can be sold. If it is sold, it is not a very attractive price, which is only 3.20 per kg will be realized. Rather, when they have purchased it at 6.30 and earning a revenue of only 3.20 per kg, it doesn't make any sense. So the sale option can be ruled out. This one will be cancelled off. So the option is for H should be used for the special contract. So the choice is H is used or J is used. Two different things. Since sold part of it is because of the price, which is 3.20, much lesser, the option will be to use material H. But material H is not completely available. Their requirement is 4,200. That's their requirement. Now, only 3,700 kgs of material is available with them. So 3,700, the relevant cost for 3,700 has to be considered. And what about what about the remaining part of um, 4,200 minus 3,700, the remaining part of the quantity of material? What will they do? So that is the option what we are looking at. The consideration part of it goes accordingly.
So are they looking for the best material mix?
In terms of cost, what is relevant? Only that aspect. In terms of contract, see, it doesn't talk any other information about which material is better or not. It's only about H versus J. That's it. So H is already acquired. It is there with them. Right now, they will not be looking at considering the historical cost. So the present value, the present details are about uh, purchasing the material at what price. So for J material is regularly used and 7.50, 3.7 is the relevant cost which is talking about. So the relevant cost part of it is fine. But this rate is applied for how many kgs? So that is the point what I am looking at. 3,700. The price of material H is 6.30. Um, uh,
Since we have 3,700 kgs, that means we definitely have to buy 500 kgs of
500
H.
anyway, additional plus 500. That additional 500, if it has to be purchased, the choice is again that is clear about 500. But 3,700, I am trying to figure it out. 500
So,
is the comparison between 7.5 or 6.3. So the best one is 6.3. So at 6.3, 500 will be purchased. 3,700 is already purchased. So already purchased historical cost cannot become relevant cost. 6.3 for 3,700 is irrelevant.
and so the cost for 500 kgs will be 6.30
Huh.
because we have to,
Yes,
what do you
that's right.
say?
That's
We
right.
have to purchase.
We have to purchase. I mean, the purchase part of also the choice is there, 7.5 or 6.3. Between the two, it is 6.3 is better.
Yes, ma'am. But what do you say? Because we can have two things for 3,700 kgs of material. Then, ma'am, we can either spend, what do you say, 3.7 per kg to make material J, or we can sell it at 3.20, ma'am.
So H is modified as J, isn't it?
Yes, ma'am. Yes, ma'am.
Okay.
Ma'am, so if the relevant cost become, if we can spend 3 point, we cannot say that 4.50 is relevant because it's a sunk cost now, ma'am. So it's
Uh-huh.
irrelevant.
Yeah.
And so either we can sell the material H for 3.20, or we can convert it to make material J.
Yeah.
Ma'am, so that means that what is that? 3.20 would be the minimum cost incurred.
This is
And
uh-huh.
but we have the a better alternative where we can spend 3.7 and we can get a material that's worth 7.50 per kg.
Huh. See, the current market price of this is 7.50. This is converted into J. So the modification part of conversion modification is 3.7. So instead of spending 7.50, they would not be spending because it's already there. So at the current relevant market price 7.50, out of that 3.7 modification cost is taken out. So the cost which is relevant at the moment for them is 3.8. But 3.8 is applied only for 3,700 kgs. So that is how so 3.2 is not an option because 3.2 will not serve them the purpose. Even if they sell them at 3.2, again it has to be either acquired at 6.3 or 7.5. There the cost would be increasing. The sale option is completely ruled out. Now, the relevant cost of, we have to split this 4,200 into two different parts. So relevant cost of material is equal to, the first part of it is 3,700 kgs into the relevant cost. Relevant cost, we already got it as 3.8. Because in store, they have only 3,700. So the remaining part of 500 kgs will be acquired at either 6.3 or 7.5. So 6.3 is better, so it will be acquired at 6.3. Okay, first option 17,210. here, this one is joint products. So relevant cost, there are multiple decisions. One decision is about joint products. So let's see what is the decision criteria there in case of joint products. A company manufactures two joint products and a byproduct in a single process, which are all sold as soon as they are output from the process without further processing. Joint costs are shared on the basis of sales value at the split off point, and the revenue from the byproduct is credited to the cost of production. The budget of for the next period is as follows: process costing is 45,000. Output in units, we have the output. Selling prices are given. The cost per unit of product Y is how much? See, sometimes when the production process is taken up, the initial stage process, if it is same for more than one product, all the products which require the initial process, which is the same initial process, they go through the same process. So when they go pass through the same process, the cost incurred are incurred as joint cost. Okay. So the accounting part of it is about the joint cost. So initial stage, when all the products, when they pass through the same process, the cost which is incurred till a point where they are separated. Separated point is called a split off point. The separated point is called a split off point. So the costs now are incurred for all the products, and this is a joint or a combined cost. Done. After they get split out, and that is they get separated. When they get separated, the costs which are incurred after separation, let's say if there are some more additional costs, they are called as after separation costs or separable costs. So now there are two sets of costs. So throughout the production process, the first set of cost is as incurred as a joint cost. The second set of cost is after separation cost. But ultimately, for every product, the total cost should be known. Fine. The total cost of the product should be known so that the profit margin is added, price can be known. The concept is about how to distribute this joint cost. The joint cost has to be allocated. There are various methods of allocating joint cost. The method which they are adopting here about allocating the joint cost. What is the total joint cost? The budget for the next period is as follows. Processing cost is 45,000. Outputs are given to us. The method which they are using, the joint costs are shared on the basis of sales value at the split off point. So if at all, sometimes even if they are in an intermediary form also, they are not completely processed. After separation, even if there is a further processing to be taken up also, some of the products as intermediary products also have a market. So the concept is, should they be considering selling these products at the split off point or after further processing is a decision criteria which will be taken. But now in this particular question, the question is asking us allocate the total joint cost, the processing cost, what is mentioned there. We don't have any other information about what is the further separation cost and what is the sale value after further processing. All that information is not there. It is just preliminary. So they have incurred joint cost, they get separated. At the point of separation, they can be sold, and each product has a sale value of this much. The method which is used to allocate the joint cost is based on the sale value at the split off point. So first find out what is the sale value of the products at the split off point. Take that as the basis and allocate the joint cost. So first let's start. There is another twist also here which we have to look into. I will let you know that part also. So starting with, the first question under joint costing, 171 question. How many products are produced here? There are three products. One is joint product X. Another one is joint product Y. The third product is not joint product, but it is a byproduct Z. What does it mean by joint product? What does it mean by byproduct? Joint product is products are those products which are intended to produce. The intention is to produce them. More or less, all joint products have uh, equal value, same value, or they are their intention is to produce them, so they are called as main product. But because of the production process, we also see that some other output also can be produced, which has very less value. They have very less value in terms of comparison with the main product. You must have learned about cost statement in cost accounting. So I hope you remember what is the treatment of scrap value. Scrap value is the material which gets destroyed, damaged. It cannot be used in the production process. So what do? They sell away that material. So when they sell that material, it is not sale value. It is scrap, sale of scrap. So that part of revenue which is earned, or that part of income which is earned, is adjusted against the total factory cost. You remember that factory overheads under works cost, we write all the factory overheads, and if there is any amount of sale of scrap, that is deducted from the total factory overhead cost. Same is the concept with byproduct also. So any revenue which is generated out of sale of byproduct should be adjusted against the total amount of process cost, and the remaining amount of process cost only should be allocated to the main products, the joint products. That is the point. But let's first find out what is the sale value at the split off point. First, let's see the output. Sorry, these are selling prices. No? 250 units, 400 units, 3000 units. The selling price is 80, 100 and 0.20. Processing costs, we see them as 45,000. There's some amount of revenue which is generated by sale of the byproduct. Okay, so that has to be adjusted against the processing cost. The processing cost is 45,000. From 45,000, we have to deduct 600. The rest of the amount only should be allocated to the main products, the joint products X and Y. Okay. So what is the basis of apportionment X and Y? The basis of apportionment for X and Y will be based on the sale value at the split off. Sale value at the split off is 20,000 and 40,000, isn't it? 20,000 and 40,000. So 1:2. Less sale of byproduct. 600. So joint cost to be allocated is equal to 45,000 minus 600. The ratio is already, this is the sale value 20,000 and 40,000. So the ratio will be 1:2. So let's check this one. $44,400 is equal to 44,400 into 1/3, isn't it? 1:2, no, 1/3. And the other one, so this is the total joint cost which is allocated. Now we are asked to find out what is the cost per unit for product Y. Cost per unit will be the cost allocated divided by the number of units. P Limited is considering whether to continue making a component or buy it from an outside supplier. So here the choice is about making a component. So it is the choice about make versus buy. Make the component or buy the component from an outside supplier. It uses 12,000 of the components each year. Internal manufacturing cost comprises direct material, direct labor, variable overhead, specific fixed overhead, other fixed overhead. If the direct labor were not used to manufacture the component, it would be used to increase the production of another item for which there is unlimited demand. This other item has a contribution of 10 per unit but requires $8 of labor per unit. Okay. Simple terms, how do we take a decision if it has to be? See, we are not, the decision is not applicable when the total product, the finished goods are purchased and sold. That is trading. Here, manufacturing activity would be carried out in the production, the factory. The decision is only about one component. When multiple components are assembled to make the final product, sometimes they may not have the expertise in manufacturing one component. So the choice is about that component. We are not talking about the finished products. We are talking about one component. See, for example, let's say the um, wristwatch which we wear. The watch has multiple components. Let's say if it is a leather watch, so there is a leather strap, there is an eye glass frame, the main motor is there, steel handles are there, buckle is there, steel buckle is there. So we see that there are multiple components there. Let's say that watch manufacturer will have his expertise in making the watch motor or the machine of the, maybe he doesn't have that expertise in terms of cutting the leather into sizable straps and all, so maybe he is not expert in that part, or a glass frame or something like that. So when the products are manufactured, multiple components have to be used. Sometimes some of the components they use it only for that particular purpose and very small in quantity and all. But someone who's dealing with that component exclusively, that supplier, for them the cost will be at a cheaper value, because we understand the economies of scale. When the production is taken up at a large scale, the cost will be lesser. Someone for outside supplier, it is cheaper, but for the business, it may be costlier. For that reason, they consider either to make that component in the factory premises or purchase this component from external suppliers. So that is the situation. If we are looking at that. See, for making, what are the costs which are incurred? If we are talking about a make or buy concept, let me put it here so that you will also have that. So we're doing question number 172. Decision about make or buy. If making, what are the costs which are incurred? Variable cost would be incurred, fixed cost also would be incurred. So this variable cost will be incurred, fixed cost also will be incurred. Done. What if they buy? They buy, they will have to pay the price to the supplier's price. So that will be the cost which they have to incur. Now coming to the meaning of what is variable cost and what is fixed cost. Variable cost varies proportionately with the output. Fixed cost does not vary with the output, with the changes in the output. See, if they stop manufacturing the component, will they stop incurring fixed cost? No, they still continue to incur the fixed cost. The same amount of fixed cost will be incurred. So even if they are buying, they would be buying, they would be incurring fixed cost. If the decision is about make or buy, for making the component, they have to incur variable cost, and the total fixed cost anyway would be the same. The fixed cost will be unaltered even if they go for buying the component. So they have to incur fixed cost. They plus they also have to pay the supplier's price to the supplier, price of that component. So here in this case, we see that there is one cost which is completely irrelevant. This is irrelevant because it is not changing with the decisions. Whether they make it or whether they buy it, it will be incurred. So this can be mentioned as irrelevant in nature, irrelevant cost. So the decision is between what is the variable cost versus what is the purchase price offered by the supplier. So the decision will be, if the variable cost is less than the supplier's price, go ahead and make it in the factory. If the supplier is offering at a lesser price than the variable cost, buy it from the supplier, not considering what is the amount of fixed cost. Even if fixed cost is considered also, it will be added to the variable cost, it will be added to the supplier's price. So that portion of it is irrelevant in nature. So the decision should be between the variable cost and the supplier price. Okay, that's the decision criteria. The question has additional information also. If the direct labor were not used to manufacture the component, it would be used to increase the production of another item for which there is unlimited demand. This other item has a contribution of 10 per unit but requires $8 of labor per unit. So if we were to take a decision about a make or buy, simple terms, then what do? We just have to make a comparison between what is the variable cost and what is the supplier's price. That is all what we have to look into this one. These are the set of costs. These are the set of costs. Out of that, the first three are variable. The next two are specific fixed cost and other fixed cost. So these two costs we see that are fixed in nature. Variable component we see 3 plus 4, 7. 7 plus 1 is 8. Okay. Then out of fixed cost, there is one cost which is called as specific fixed cost. Specific fixed cost, or I have also explained to you one term which is called as traceable fixed cost. You remember? So there are two different types of fixed cost. One is traceable fixed cost, one is unavoidable fixed cost. So the traceable part they have mentioned it as specific fixed cost. So this is also, if they manufacture, they incur. If they do not manufacture, they do not incur that. That is the meaning of it. So the decision, the relevant cost for the decision will be until the specific fixed cost. We've learned about the meaning of what is traceable fixed cost. So if they do not manufacture, they don't incur this cost. So the relevant cost added up to 3 plus 4 is 7 plus 1 8 plus 2.5 10.5. So that's the relevant relevant cost. Relevant cost is 10.5. Fine. Other fixed cost in any case will be incurred whether they make it or whether they buy it. Now, if the direct labor, the concept, let's first write this one about what is the relevant cost. The relevant cost comes up to be as a 10.5. There is no supplier's price, no. what the question says that what is the maximum price per component at which buying is preferable to internal manufacture. So which means that the buying price should be less than the relevant cost if it is made. So if they are made in the factory, whatever is the cost which comes up to, it is, see, there is one adjustment in between, otherwise it would be 10.5. We also have to consider that adjustment. So all the costs which are relevant in nature, till now we have 10.5 plus some adjustment is there. So the purchase price should be less than that cost, then it is acceptable. Fine. So what is the maximum price? So or rather, where at what point both of them are equal. So that is the concept there. What is the maximum price? So let's see what this adjustment is all about. Let's say if the direct labor were not used to manufacture the component, it would be used to increase the production of another item for which there is unlimited demand. This other item has a contribution of $10 per unit, but requires $8 of labor per unit. Present cost which they are using for labor is 4. If they divert it, see, let's say they take a decision about not producing this component, outsource it with the supplier, so labor will be diverted. Right now their labor cost is only 4. If they divert it, on diversion the labor cost will be doubled. The labor cost will be doubled as 8. Okay, 8 will be the labor cost. So exactly 2 times of the labor cost. After doubling the labor cost, they can earn a contribution of 10. The contribution is now, for them it is an opportunity cost. Right now they would not be considering the manufacturing. They would not consider manufacturing, but um, uh, they would prefer placing the order with the supplier. But apart from that, this variable will be diverted, and this variable will give them a benefit of $10 contribution. But $10 contribution where double resources are contributed. But this set of contribution, only 4 is contributed. When 8 is 8 is the labor cost, contribution is 10. When 4 is the labor cost, contribution will be only 5. That's the point. So let's first talk about the opportunity cost. First thing is they would not be incurring the variable cost or the relevant cost, which comes out to be as 10.5. Okay. Now there is a opportunity cost also which is present. That is their possibility of when they make that, can they earn the contribution? When they make the component, can they make the contribution? They cannot make the contribution. So that contribution is foregone. So that contribution is an opportunity cost for them. So now the relevant cost are, I will once again explain to you, don't worry. Relevant cost are 10.5. Add opportunity cost. Opportunity cost. How do we get this opportunity cost? See, here we can write it as for $8 labor cost, contribution is $10. But right now their labor cost is only 4. So for for labor cost, contribution will be $5. We have 15.5. The decision criteria is between what is the variable cost or what is the relevant cost versus what is the supplier's price. The relevant cost here we see all variable cost and traceable fixed cost added up together, we got it as 10.5. Now, if they make the component, they will forego that additional contribution which they can earn at the rate of $10 when $8 labor cost is used. But now they have only $4 labor cost, so the contribution will be only $5. So add $5, so 15.5 what we got. So now if it is 15 point, at least 15.5, they can think about placing the order with the supplier. If it is anything about 15.5, rather they make it in their own premises, in their factory. That is the concept here, make versus buy. So the maximum what can be allowed with the supplier. See, if it is 15.5, it is not the maximum. It is indeed it would be indifference. Either this or that, both of them will have 15.5. That is an indifference point. It should be at least something less than 15.5. But of course, we are asked to talk about the maximum point. The maximum can be as high as 15.5. So the maximum price per component. The 15.5 is the answer. Once again, I hope you got it. I do not know. Big concept and one go I have explained. If the decision is between making the component or buying the component, this is the decision criteria. This is how we go ahead. But here it is not only this part of it. They are also talking about there is an opportunity cost which is present. So first we have identified all the relevant costs. The direct material, direct labor, variable overhead, and also there is one traceable fixed cost. So that is if they manufacture, they incur. If they do not manufacture, they do not incur. So that is a specific or relevant fixed cost. So all of them added together, we got it as 10.5. Not only this, but they also mentioned that, see, when they don't manufacture, what will they do with the labor? They divert it to some other product. So when they divert it, they can get a contribution of 10. But 10 can be earned only when $8 labor cost is incurred. Right now, how much labor cost are they incurring? Only $4. So when they incur $4 labor cost, contribution also will be only 5. So that is an opportunity cost. Opportunity cost which they will be foregoing if they make that. If they do not make that, they buy it, they can earn that. So right now we are discussing about what is the total cost incurred for making that, because we need to decide on what is the supplier's price. So now 5 is also one something which is foregone. So add that 5 to 10.5, so which is 15.5. So 15.5 is the maximum allowed price with the supplier. If it is anything above that, it is better to make it either 15.5 or less than 15.5. Order can be placed with the supplier. Any doubts? Any doubts? You there?
Ma'am?
Yeah.
Ma'am, so this opportunity cost here denotes the profit of making that component, ma'am. I mean, like the profit we earn from that.
What is opportunity cost? Cost of foregoing the next best alternative. See, because they are taking up making that, they will forego this. So that is a lost revenue. Lost revenue is 5. Lost revenue is a cost for them. So that's opportunity cost. Cost of foregoing the next best alternative. When they take up making the component, they will not have the possibility of making $5 contribution. Contribution is possible only when they divert the labor cost. When will they divert the labor cost? When they do not make it. So right now, what they are not being able to enjoy is their cost, foregone revenue, foregone cost. Foregone revenue is a cost for them. On that note, it is an opportunity cost, so that has to be added. That's the concept here.
Okay, ma'am.
You have to update with your coordinator and then keep me posted about whether there would be a class in the morning or not. Suddenly, but right now my schedule says I'm free in the morning slot until 2:30. I am free. 2:30 I have a class, so let's take it till 2 o'clock. So confirm that with the faculty and then get back to me. Even in the group also, that's fine because I will also be looking into the group. So please take it up urgently. Okay. Question number 173. A company manufactures a range of products, one of which product L incurs a total cost of $60 per unit. The company manufactures 50,000 units each year, and the directors wish to achieve a return of 20% of the total capital of 10 lakhs invested in the company. Based on this information, the cost plus selling price of one unit of product L should be. Okay, the company manufactures 50,000 units here and there. 20%. Okay, this is simple. The concept is we are asked to find out what is the cost plus selling price. Simple concept. Just calculate that and tell me. The number of units are given. The total cost per unit is $60 per unit is the total cost. Fine. Find out the total cost of all the units, 50,000 units. Add a profit margin. Profit margin, the profit amount what they want to earn is 20% on the investment amount. Investment is 10 million. Just add that to the cost price to find out what is the um, next we need to add um, and the directors wish to achieve a return of 20% on the total capital of 10 million based on the information the cost plus selling price of one unit of the product. Cost plus selling price. First, let's find out what is the profit margin. Calculate that. The number of units are 50,000. Okay, so that's the answer, $100. So we'll end the class here. Immediate, see, even if late in the night also doesn't matter, but please post a message there, or you can directly post a message to me on my WhatsApp. Then we'll take it up tomorrow's class in the morning. But if that doesn't work out, let's see where we can fit that. So I have mentioned the options. That is, Tuesday is an option which is completely available. We can have two slots there. We'll see. Tuesday you said it is not possible. We'll see where we can fit that. Because if you said there is no other issue with the extending into coming week also, we can also fit that. So let's end the session here. You take up the work of contacting the coordinator and getting back to me. Right? Okay then.
Thank you, ma'am.
Okay. Good.
Thank
Bro.